So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately. Starting with this one here from my friend Alex on YouTube, who wants to know, do you think it's better to go into dividend investing or growth? And that's a fantastic question. I feel like this gets brought up a lot, and here's the thing, you don't have to choose between dividends and growth. For some reason, there's this widespread belief that you can either invest in dividend stocks or you can invest in growth stocks, but the two are not mutually exclusive. I think this is something that a lot of investors get wrong. The truth is, you can invest in companies that are both paying a dividend and growing. In fact, I think those are some of the best businesses you can own. I'm not exactly sure where the idea came from that you can either be a dividend investor or that you can be a growth investor, or that there are dividend stocks and then there are growth stocks, like they're two completely different species. In reality, there are growing companies and there are non-growing companies, and there are companies that pay a dividend and companies that do not pay a dividend. Now, whether or not a company pays a dividend, you do want to be invested in companies that are growing. That should be non-negotiable. After all, why would you want to put your money into something that doesn't look likely to be bigger and better in the future than it is today? Now, as far as the dividend goes, that more so comes down to preference. Personally, I only invest in companies that pay a dividend. There are a few reasons for that, which could be a video all on its own, but that's just what I like. And again, there are tons of companies out there that give you the best of both worlds, that give you some dividends and also are growing. Like, I think Visa is a shining example of this. Although it doesn't have the highest dividend yield by any means, coming in at less than 1%, it is still a rapidly growing dividend-paying company. Along with Visa, I think Zoetis is another great example. Like Visa, this company is growing like a weed from top to bottom, and this trend is carrying on down to the dividend, which has been increased by more than 20% per year on average over the last 5 years. Even on the higher yield end of the spectrum, we can look at something like Main Street Capital Corporation. Since Main has a yield close to 7%, it usually gets thrown into the dividend stock bucket, but it's also been a very solid grower, both in terms of the financials and in the share price. As we can see here, in the last year, the share price is up 30%, so it really has a lot to offer all around, and that's why I don't think it's helpful to get too caught up in these labels. Instead, I think you're better off trying to figure out what actually matters to you in an investment, which, may take some time to figure out, and that's okay. But once you do get an idea of what you're looking for, just try and follow that. But anyway, moving on to question number 2. This one comes from Alvaro, who wants to know, if a company cuts their dividend, would you sell it right away or would you still hold on to it? And this is another really good question. Early on in my investing journey, I used to think that if a company cut their dividend, it was an automatic sell, no questions asked. But after a few years now of doing this and being on the receiving end of a couple different dividend cuts, I've learned that the context behind a dividend cut matters. It's not always so cut and dry. There have been a couple instances where a company has cut their dividend and I decided to hold on to it, with a recent example being WP Carey. Toward the end of 2023, they lowered their dividend after spinning off their office properties into a completely separate company. In this case, I didn't sell because I didn't think that the cut came from any fundamental weakness in the business. The company just simply spun off a ton of their assets, and so the dividend was no longer sustainable at its old level because of that. Some investors would look at that and say, okay, a cut is still a cut, and that's really all that matters. But like I said, to me, I think the reason matters a lot. I mean, compare that to a situation like Walgreens. They suspended their dividend earlier this year, and to be honest, you could have seen that coming from a mile away. All you had to do was look at the earnings and free cash flow trends to know that the dividend wasn't sustainable. And I think Intel is another example, kind of like Walgreens. Intel cut their dividend back in 2023 and then completely suspended it in 2024. And based off the multiple years of declining earnings and negative free cash flow, it's safe to say that the financials just couldn't support a consistent dividend. The way I see it, both Intel and Walgreens had become fundamentally weaker businesses, and that's a totally different story than what happened with WP Carey. With all of that said, I believe that understanding why a company cuts its dividend is really important. If it's akin to something like an Intel or a Walgreens, it's probably not a company that you'd want to own no matter what, regardless of whether or not it paid a dividend. But anyway, now moving on to question number 3. This one comes from Blake, and Blake wants to know, what are your thoughts on allocating your REITs over to the Roth? I've been playing with that as well since it's tax advantaged. Yeah, this is something that I've gone back and forth on quite a bit. It obviously makes sense to put your REITs and other non-qualified dividend payers into a tax advantage account like a Roth IRA, since it helps eliminate the tax inefficiencies that come with those type of assets. And just as a quick refresher, non-qualified dividends, which are also called ordinary dividends, are taxed at your regular income tax rate, just like the income from your job. Qualified dividends, on the other hand, are taxed at the lower long-term capital gains rate, which maxes out at 20%. Because of that, a lot of people default to the idea that real estate investment trusts are best held in your Roth IRA since they can shield you from the higher tax rate, and in many cases, that's true. I think you can make the argument that any asset that creates a taxable event would benefit from being in a tax advantage account like a Roth IRA since it completely eliminates the need to pay taxes, but I think that there's also more to consider than just taxes. Your time horizon, for example, also plays a big role in all of this. In my case, I plan to start using some of my dividends long before 59 and a half years old, which is when you can begin withdrawing your profits and your dividends from a Roth IRA without any penalties. So for me, I think it makes more sense to keep my REITs in my taxable account. Even though I'll pay taxes on that income, I'll also have the freedom to access that money whenever I want. And in my situation, that freedom, at least to me, is worth the trade-off. Now, if you're someone who doesn't plan on using any of your dividends until something closer to the standard retirement age, then my way of thinking probably won't make the most sense for you. In your case, yeah, you're probably better off optimizing for the best possible tax situation. With that said, though, once again, it's not a black or white issue either way. And if you haven't already, you'll find that's true of most things in investing and personal finance. So once again, there's always that gray area that doesn't get talked about as often as I think it should. But anyway, moving on to the fourth question, guys. This one comes from Share Success 7849, the one and only, who wants to know, I look at buybacks and see them as a way a company can use the process to manipulate earnings, to make them look better than they really are. Do you have an opinion on this? Am I wrong in my assumptions? Now, this is a fantastic question. I don't think you're wrong to be skeptical. Buybacks can be used in a manipulative way, especially if a company is heavily relying on them to boost their earnings per share every quarter. But buybacks aren't inherently bad. Like anything else, they're a tool, and at the end of the day, it all comes down to how they're used. Warren Buffett actually laid out a great framework for thinking about buybacks in his annual shareholder letter from 1999. He said there's only one situation where they make sense. First, he says the company has available funds, cash plus sensible borrowing capacity beyond the near-term needs of the business, and second, it finds its stock selling in the market below its intrinsic value, conservatively calculated. So really, according to Buffett, there are only two boxes that a company needs to check for buybacks to make sense. First, it has excess capital that isn't already earmarked for more pressing priorities, and second, the stock has to be trading for less than what the business is really worth. If those two conditions are met, then buybacks can be a great use of capital because they can increase your ownership of the business without you having to buy more shares yourself. And that increased ownership can benefit you in a couple different ways. First, it reduces the number of shares outstanding, which can boost the share price over time due to simple supply and demand. Fewer shares means each share remaining represents a bigger slice of the company. Second, it increases your share of the company's dividends. With fewer shares to pay out to, a company can either reduce its total dividend payments while maintaining the same dividend per share, or it can keep the total payout the same and raise the per share amount. Either way, it makes the dividend easier to sustain and grow. So overall, buybacks can definitely be abused, especially if they're executed at the wrong price. But at the same time, they can also be a great way to create value for shareholders. It just depends. At any rate, now moving on to question number 5, which comes from my good friend ex-dividend dad. He wants to know, what's been the toughest break for you this first half of 2025? Anything you wish you did or didn't do? To be honest, I feel like 2025 has been pretty tame so far. There have only been a couple notable moves in the portfolio so far this year. First off, most recently, as a lot of you know, I started a new position in Zoetis, which I feel really good about. I think Zoetis is a very high quality company, and I bought in at a pretty decent price after the stock had pulled back. We'll see how it plays out over time, but so far I'm really liking the setup, and I'm still buying the stock every single week. With that, the only other notable move I made was selling out of Altria Group. I talk a lot more in depth about why I sold it in a recent video, but I also feel really good about that decision. I owned Altria for around 5 years, pretty much ever since I started investing, so it was a really hard one to let go of, but fortunately I did make a solid profit on that position, and I do think my reasoning for selling out of it made sense. You guys will have to check out the video and let me know what you think. Outside of what happened in 2025, though, there is one recent move that I think I could have handled better, and that was my entry into Clear Secure. I started this position late last year after the stock had already seen a pretty big run up, which is probably where I went wrong, because not long after I started buying, the share price started pulling back. So I've been sitting on a loss pretty much the entire time that I've owned this position, which is pretty bittersweet. On the bright side though, I did add a lot more to Clear Secure as the share price was coming down, which really helped me lower my average cost per share by quite a lot actually. So it was a net benefit to my position, but still, I think I could have handled this one with a bit more discipline and I could have been a bit more patient with it. All in all though, I still think Clear is a great company and it's growing like a weed. I think I'll be fine in the long run, but I can also see how I could have approached that one a little more thoughtfully. So yeah, that wasn't my best move, but honestly, it was a good reminder that even with dividend stocks, there are plenty of ways that things can go wrong. And I'm actually telling you more about that in this next video right over here. In this one, I'm breaking down 5 warning signs to help you know if that dividend stock you're about to buy is a big mistake. These are some of the frameworks that I use. I think these are really important and you'll get a lot out of them. So click right over here to check those out and I'll see you in the next one.